No one's ever gone bankrupt without any debt. Now that would take a real, I think you have to give some kind of distinguished service award to somebody who did that.
Most Wall Street guys know that investing is a matter of chance. So why does Peter Lynch seem to always come out ahead, even if he takes the same risks as everyone else? Let's face the fact. If Lynch had his retirement party at the age of 46, why can't you have yours before 40? Want to know how? You found the right spot if you want to double your investing success rate. This video takes a look at the unconventional methods of investing that have led to his rise to the top of the financial world. The secrets behind Peter Lynch's phenomenal success will soon be unveiled, so stay tuned. The investment philosophy of the legendary investor is simple but effective. Put your money where your head is. He thinks you might be able to find undervalued companies with the help of your own expertise and views. When compared to many other investors who instead prioritize intricate financial studies or stock market trends, this is a notable difference. However, Lynch's technique is straightforward, comprehensible, and perfect for average people like you and me. So, how do we go about implementing this plan? The first step is obvious. Think about what you use on a regular basis. Have you become a regular at Starbucks? Maybe now is the time to investigate their assets. You just can't live without your Apple gadgets, can you? What to invest in is obvious to you. Select well-known companies, look into their foundations, and see if they are reasonably priced. The great thing about this approach is that it does not just rely on numerical and graphical representations. Investing successfully is about honing in on the organizations and brands that move you and using that information to your advantage. But what does Peter Lynch look for when sifting through the stock market for promising investments? In his book, One Up on Wall Street, he outlines some of the most important factors that investors should take into account. Let's take a peek at Lynch's secret to consistently outperforming the market. Be sure to take notes. Number 1. Invest in growing companies. Lynch values progress greatly. He thinks there's a chance of making a lot of money by putting capital into fast-growing companies. To unearth these gems, he recommends keeping an eye out for a company that is both stable financially and rapidly expanding its market share and competitive advantages. Just think of how Amazon went from being an online bookstore to a retail powerhouse. Investing in rapidly expanding companies like Amazon is a great way to capitalize on their success. Secondly, you need to check the earnings. That's the very essence of any business's worth. Money in the bank is crucial. According to Lynch, it is the primary factor in determining a stock's price. Think about these things as you evaluate a company's earnings potential. Growth in earnings per share, EPS, profit margin, return on investment, ROI. Think about Apple, for instance. Investors like it because of its solid track record of profit growth and healthy profit margins. Number 3, dividends, the cherry on top. Who wouldn't welcome a few extra percentage gains? Lynch places a high value on dividend-paying companies because they provide a reliable source of income, provide financial stability, and open the door to reinvestment and compound growth. Consider the ubiquitous Coca-Cola. This dividend-paying corporation has been rewarding shareholders with annual raises for over half a century. Fourth, using the price-to-earnings ratio to determine worth, Lynch places a premium on a low price-to-earnings ratio, PE. To determine if a stock is reasonably priced or not, he consults it. Here's how to put this idea to good use. Check the PE ratio of a firm against its rivals in the same market. Consider purchasing shares of companies whose PE ratio is less than their growth rate. A technological company with a PE ratio of 15 and profit growth of 20% per year may be a fantastic steal. Number 5, calculating the debt-to-equity ratio. Check out the debt-to-equity, DE ratio, of a corporation to learn about its use of leverage. This metric will reveal whether or not a business is financially stable. The DE ratio may be calculated by dividing total liabilities by shareholder equity. Peter Lynch suggests keeping debt to equity low. Why? If a firm has a low debt-to-equity ratio, it means its debt is manageable and it will be less likely to get into financial trouble. That is to say, a higher return on investment and a smaller DE ratio go hand in hand. Number 6. Catalysts, the spark that ignites growth. Lynch is constantly on the lookout for catalysts, events, or factors that may lead to an increase in the price of a company. These include things like new product releases, industry trends, and mergers and acquisitions. Potential growth opportunities may be capitalized on with the help of early identification of these catalysts and social arbitrage opportunities. Number 7. Choosing the winner in a niche market. Businesses that dominate specific niches typically have a substantial competitive advantage. Since these pioneers maintain and grow their market dominance so effortlessly, Lynch favors them. So, what is a good illustration of a stock that dominates a certain market segment? Think of a company that has not only found a profitable niche, but has also become the undisputed leader in that market. Yes, I am talking about Tesla, the forerunner in the EV market that has made its competitors look like amateurs. Lynch suggests keeping a lookout for stocks like these. Number 8. Inside ownership. Who is purchasing? Before putting money into a company, Lynch says you should find out who else is putting money into it. When corporate insiders, such as executives and board members, possess a sizable stake in the business, it's an indication that they have confidence in its long-term prospects. The fact that these insiders are increasing their share purchases is more evidence that you are on the right track with your investing strategy. Number 9. Strong management team. Who's in charge? The success of an organization depends on the quality of its management. If the leaders of the company lack experience and insight, the enterprise will undoubtedly fail. And get ready for a financial slump if you buy shares in a company that is struggling. Because of this, Lynch meticulously researches the track record and expertise of a company's management team before making any investments. Next, find the businesses that make sense. Do your best to make it logical. Lynch recommends putting money into straightforward businesses and staying away from unknown sectors or groups. You shouldn't put money into a company you don't understand. Lynch was told, know what you own and why you own it. Lastly, using a contrarian approach to find hidden gems, Peter Lynch says you should follow the beat to your own drum and stop following the herd. Lynch finds gold in the rough by intrepidly venturing to uncharted regions of the stock market. When their true worth finally emerges, these equities might significantly exceed the market. This tactic, of course, requires a keen eye for spotting companies with solid underpinnings. Keep in mind that Peter Lynch's strategy isn't a magic bullet. You, as an investor, must come to terms with your own personal investment objectives, risk tolerance, and strategy. Take what resonates with you and use it to inform your own investment approach. Now, I assume you're wondering, how does Lynch find multi-bagger stocks? Peter Lynch has earned the label of master investor thanks to his remarkable ability to pinpoint rising value assets. Among his most significant findings are well-known entities like the limited Taco Bell, Volvo, Dunkin' Donuts. Apple. Okay, let's talk about what makes Peter Lynch such an iconic figure in finance. He became manager of Fidelity's Magellan Fund in 1977 and promptly elevated its status. He managed to make it the best-performing mutual fund in the world over a period of 13 spectacular years. The fund's holdings increased from $18 million under Lynch's watchful eye to a staggering $14 billion. And the icing on the cake? The fund returned an incredible 29.2% annually. well outpacing the S&P 500's 13.2% gain during the same time span. The Johnson family continues to run Fidelity as a privately held company, and it now oversees assets worth almost $8 trillion. But what exactly is Peter Lynch famous for? Value investing is a field in which he excels. He has a knack for finding undervalued gems with solid foundations and exponential development potential. Millions upon millions of people have adopted his investing strategies and are now more interested in the underlying value of a particular company than in stock market fluctuations. As a result of his lectures, value investing has gone from being a novel approach to becoming the norm. Here are a few key themes from Peter Lynch to keep in mind if you want to improve your decision-making skills in life. Firstly, focus on what you're good at and keep learning. By honing in on what you know best, you'll be able to spot opportunities that your competitors are blind to. Number 2, act like a sleuth. Do your research before making a financial commitment. You may unleash your inner Sherlock Holmes by dissecting a company's finances, deciphering its business plan, and analyzing its rivals. Number 3, recognize your inner clumsy one. Let's face it, mistakes are inevitable. Peter Lynch urges his readers not to wallow in self-pity, but rather to use their experiences to become better decision makers in the future. If you accept responsibility for your actions and grow from them, you'll be more equipped to handle the market's ups and downs. Lastly, be patient. Neither Rome nor a successful investment strategy were built in a day, so calm down, little grasshopper. Lynch maintains that the key to successful investing is keeping the big picture in mind. Don't give in to the allure of acting hastily because of temporary shifts in the market. Keep your mind clear and your sights on the prize, and you'll increase your odds of success. Here you have it, 4 of Peter Lynch's most powerful concepts for improving your decision-making, financial success, and overall quality of life. Peter Lynch was able to retire at the age of 46 thanks to his great investment methods, the ideal situation. At the end of the day, it doesn't matter if you're the brightest or most experienced investor. It's all a matter of perspective and the will to improve yourself and your situation. Why not benefit from Peter Lynch's experience and apply what you've learned to your own investing strategy by reading up on his life and financial philosophy? The results might end up surprising you. Since I have given you these secrets, don't forget to like this video and subscribe for more money-making videos from this channel. See you soon.